China's central bank has emerged as the world's most aggressive official sector gold buyer, systematically adding approximately 300 tons to its declared reserves over the past 18 months, according to People as Bank of China monthly data releases. This represents roughly $18 billion in purchases at current prices, making Beijing the dominant force in official sector demand that has underpinned gold's resilience despite hawkish Federal Reserve policy. This accumulation pattern represents far more than routine portfolio diversification. The timing appears deliberately strategic, with Chinese purchases accelerating notably following the February 2022 freezing of Russian central bank assets worth approximately $300 billion. Western nations demonstrated their willingness to weaponize the international financial system, likely crystallizing Beijing's assessment that dollar-denominated reserves carry unacceptable political risk, regardless of their liquidity advantages. Traditional reserve management theory, codified by institutions like the Bank for International Settlements, suggests central banks should prioritize liquidity, safety, and return in that specific order. Gold performs poorly on the first and third criteria. It cannot be quickly mobilized during currency crises like treasury securities, nor does it generate nominal yield in a world of positive interest rates. Yet China's behavior indicates a fundamental recalculation of this framework, where geopolitical insurance value now outweighs conventional financial metrics. The scale of accumulation matters significantly for global market dynamics. China's reported holdings have increased from roughly 1,800 tons in 2020 to over 2,200 tons currently, though most analysts suspect actual holdings substantially exceed official figures, given China's history of underreporting strategic assets. Concurrent with physical accumulation, Beijing has systematically developed alternative monetary infrastructure. The Shanghai Gold Exchange now rivals London's LBMA in daily trading volumes, processing over 2,000 tons annually in spot transactions. Meanwhile, the Shanghai International Energy Exchange offers yuan-denominated crude oil futures contracts that have captured roughly 15% of global benchmark trading, creating viable pathways for major commodity transactions outside dollar clearing systems. China's domestic gold market dynamics provide crucial context often overlooked by Western analysts. Annual mine production of approximately 350 tons makes China the world's largest gold producer, while domestic jewelry and investment demand exceeds 1,000 tons annually, according to China Gold Association data. This structural 650-ton supply deficit necessitates substantial imports, but Beijing has increasingly channeled these flows through state-controlled entities rather than transparent international spot markets, potentially obscuring the true scale of official accumulation. The People's Bank of China. Its communication strategy around these purchases has been notably transparent compared to its typical opacity on monetary policy matters. Monthly reporting of reserve additions through official channels suggests Beijing actively wants markets to understand this accumulation represents deliberate policy rather than opportunistic portfolio adjustment. This transparency may itself serve strategic purposes, signaling commitment to gold accumulation and potentially encouraging similar behavior among aligned nations. Monetary architecture and strategic implications. The profound implications of China's gold strategy extend beyond mere portfolio management into the fundamental architecture of international monetary relations. Beijing appears to be constructing a parallel financial ecosystem designed to operate independently of dollar-dominated infrastructure, with gold serving as the critical foundation stone for this alternative system. Yuan internationalization faces an inherent credibility problem that distinguishes it from historical reserve currency transitions. Unlike the dollar's displacement of sterling, which occurred gradually through economic supremacy and 2 world wars, the yuan lacks sufficient market infrastructure to inspire confidence during systemic stress periods. The Treasury market's $45 trillion outstanding provides unmatched depth and liquidity, while the Federal Reserve's global swap line network offers emergency dollar provision to allied central banks. China's challenge lies in substituting gold's credibility for these institutional advantages. Historical precedent suggests this approach carries both transformative promise and significant constraints. The classical gold standard, 1870-1914, demonstrated gold's power to anchor international monetary confidence and facilitate global trade expansion. However, the system's collapse during World War I revealed the rigid constraints metallic standards impose on domestic policy flexibility during economic stress. China must somehow capture gold's credibility benefits while maintaining the monetary sovereignty necessary for managing a complex emerging economy. Market mechanics increasingly amplify these geopolitical dynamics. Central bank demand has grown from roughly 12% of annual gold purchases in 2010 to over 20% currently, making official sector behavior increasingly price relevant. Sustained Chinese buying combined with similar patterns from Turkey, adding 45 tons in 2024, India, 27 tons, and other emerging market central banks. Creates a structural bid that may progressively decouple gold prices from traditional Western drivers like real interest rates and jewelry demand. The Federal Reserve's response options appear notably limited, creating asymmetric advantages for patient buyers like Beijing. Aggressive dollar defense through higher interest rates could damage U.S. economic growth and employment, while currency market intervention lacks effectiveness against price-insensitive, long-term accumulating central banks. This dynamic may provide Beijing with tactical superiority in any future monetary confrontation, particularly given China's substantial current account surplus and controlled capital account. Commodity markets offer the most immediate testing ground for this emerging parallel system. China's Belt and Road Initiative increasingly features yuan-denominated project financing, while bilateral trade agreements with sanctioned nations like Russia and Iran incorporate explicit non-dollar settlement mechanisms. The recent $400 billion China-Iran strategic partnership and expanding China-Russia energy deals demonstrate viable alternatives to dollar-based international commerce. Gold provides the ultimate settlement asset for these arrangements, offering finality that even central bank digital currencies cannot match. The timeline for meaningful systemic impact likely extends across decades rather than years, given the entrenched nature of dollar dominance. International monetary systems exhibit powerful network effects. Existing contracts, correspondent banking relationships, clearing systems, and market conventions all reinforce incumbent currency usage. However, China's systematic approach, combining patient capital deployment with infrastructure development and strategic partnerships, suggests a comprehensive long-term campaign rather than opportunistic positioning around current geopolitical tensions. Risk factors that could derail this strategy include potential U.S. financial retaliation, domestic Chinese economic pressures that might force gold liquidation, technological developments like quantum computing that could revolutionize monetary systems, or internal political changes that could shift Beijing's strategic priorities. Nevertheless, current trends suggest the international monetary system may be entering a period of unprecedented experimentation. With gold, its ancient role as monetary anchor finding renewed relevance in an era of financial weaponization and currency competition. The implications for gold prices remain complex and multifaceted. While central bank buying provides structural support, the ultimate success of China's strategy depends on whether other major economies follow similar paths, or whether technological and institutional innovations preserve dollar dominance through alternative means. What appears certain is that gold's role in international monetary affairs is undergoing its most significant evolution since the collapse of Bretton Woods 50 years ago. European responses reveal underlying tensions within traditional Western alliances. Germany and France maintain substantial gold holdings from previous eras, but show little appetite for additional accumulation, likely reflecting confidence in existing NATO security guarantees and European Union institutional frameworks. However, Italy's recent exploration of Belt and Road Initiative participation suggests potential cracks in unified Western monetary strategy, particularly if economic pressures from China's alternative systems intensify. Japan presents a particularly interesting case, given its dual role as major U.S. ally and China's largest trading partner. The Bank of Japan's reluctance to increase gold holdings may reflect political constraints rather than economic logic, as Japan's massive government debt burden makes currency stability paramount. Any shift toward gold accumulation by Tokyo would signal fundamental realignment in Asia-Pacific monetary relations. Technical market considerations and price discovery. The structural changes in gold demand patterns create significant implications for traditional price discovery mechanisms. Western markets, particularly London and New York, have historically determined gold pricing through a combination of spot trading, futures markets, and exchange-traded fund flows. Chinese accumulation, conducted primarily through direct purchases and Shanghai Gold Exchange transactions, may gradually shift price formation toward Asian trading hours and yuan-denominated contracts. This geographic rebalancing of price discovery carries technical implications often overlooked by fundamental analysts. Time zone arbitrage opportunities may emerge as Asian physical demand increasingly diverges from Western financial flows. The traditional London morning fix could become less relevant if substantial portions of global demand occur outside traditional trading hours, potentially creating persistent basis differentials between regional markets. Exchange-traded fund dynamics add another layer of complexity. Gold ETFs hold approximately 3,000 tons collectively, representing easily tradable inventory that could theoretically supply Chinese demand for several years. However, ETF redemption mechanisms designed for normal market conditions may prove inadequate during periods of sustained, large-scale official sector buying. The potential for ETF inventory depletion could force institutional investors to source physical gold directly, amplifying price pressures beyond what current models predict. Options. Market positioning suggests growing awareness of these structural shifts among sophisticated investors. Open interest in long-dated call options has increased substantially, while implied volatility curves show persistent backwardation, indicating market expectations for sustained upward pressure rather than typical mean reversion patterns. This positioning may reflect institutional recognition that traditional gold market relationships are undergoing permanent rather than cyclical change. Scenario analysis and probability assessments. Several distinct scenarios could emerge from China's gold strategy over the next decade, each carrying different implications for global monetary stability and precious metals markets. The baseline scenario involves gradual, sustained Chinese accumulation, continuing at current rates, potentially adding 200 or 300 tons annually while developing parallel payment infrastructure. This approach minimizes Western retaliation risks while steadily building alternative monetary capabilities. A more aggressive scenario might see China dramatically accelerating purchases during periods of U.S. financial stress, potentially acquiring 500, 1,000 tons annually during dollar weakness episodes. Such timing could maximize the strategy's effectiveness while minimizing costs, though it would likely provoke stronger Western responses, including potential restrictions on gold trading or mining operations. The probability of outright monetary confrontation appears relatively low, but cannot be dismissed entirely. Should geopolitical tensions escalate dramatically, perhaps over Taiwan or other flashpoints, China might attempt rapid gold accumulation coupled with public advocacy for gold-backed currency arrangements. This scenario would likely trigger severe market volatility and potentially fragment the global financial system into competing blocks. Conversely, technological developments could render gold-based strategies obsolete before they achieve strategic objectives. Central bank digital currencies with cross-border settlement capabilities might provide the credibility and independence China seeks without gold as physical constraints. Quantum computing advances could revolutionize financial verification systems, potentially making current monetary infrastructure irrelevant within decades rather than generations.